There are moments in history when entire societies believe they are becoming wealthier, even as the foundations of that wealth are quietly changing beneath their feet. These moments are rarely recognized while they are happening. There is no official announcement. No emergency alert appears on television screens. No government sends a letter explaining that the financial rules people have trusted for decades are beginning to shift. Instead, life continues normally. Families go to work, pay bills, save money, invest for retirement, and plan for the future. Yet beneath the surface, powerful economic forces begin moving in a direction that most people fail to notice until the consequences become impossible to ignore. One of the biggest misconceptions in finance is the belief that financial crises begin with dramatic events. People imagine stock market crashes, bank failures, or sudden recessions. In reality, major financial transitions often begin years before the headlines appear. The earliest signs usually emerge in places that attract very little public attention. They appear in government budgets, debt levels, bond markets, interest rates, and currency movements. These subjects sound technical and boring, which is exactly why they are often ignored. But history shows that some of the most important economic changes start in these seemingly insignificant areas. Today, many economists, investors, and financial historians are watching a combination of indicators that have appeared repeatedly throughout modern history. Public debt levels continue rising across many developed nations. Governments are spending more than they collect in revenue. Interest costs are consuming larger portions of national budgets. Central banks are navigating difficult choices between economic growth and inflation control. Meanwhile, investors around the world are increasingly focused on preserving purchasing power rather than simply increasing account balances. To understand why this matters, it helps to step back and look at a pattern that has repeated itself throughout history. Different countries, different governments, and different cultures have experienced it, yet the sequence often follows a surprisingly similar path. The details may vary, but the underlying mechanics remain remarkably consistent. The process usually begins when debt grows faster than the economy that supports it. Debt itself is not necessarily a problem. Businesses use debt, families use debt, governments use debt. In many situations, debt can be productive and beneficial. Problems begin when debt expands faster than the income available to service it. At that point, lenders begin paying closer attention to risk. This is where the bond market enters the story. Most people rarely think about government bonds, yet bonds play a critical role in the global financial system. Governments borrow money by issuing bonds. Investors purchase those bonds with the expectation of receiving their money back, along with interest payments. The interest rate demanded by investors reflects their confidence in the borrower. When investors become concerned about growing debt burdens, they often demand higher yields. At first, these increases appear insignificant. A fraction of a percentage point may not sound important, yet across trillions of dollars of debt, small changes can have enormous consequences. Higher borrowing costs mean governments must spend more money simply to service existing obligations. This leaves fewer resources available for infrastructure, healthcare, education, defense, and other priorities. As debt servicing costs rise, policymakers face increasingly difficult decisions. They can reduce spending, raise taxes, borrow even more money, or attempt to stimulate economic growth. None of these options are painless. Each carries economic and political consequences. History shows that governments often choose paths that reduce immediate pressure while creating longer-term challenges. At this stage, many people still notice nothing unusual. Employment may remain stable. Markets may continue rising. Asset prices may continue climbing. In fact, some of the strongest-looking periods in underlying imbalances were quietly growing beneath the surface. The next phase involves the purchasing power of money itself. This is where many people become confused, because the numbers they see often fail to reflect what is actually happening. A person may have the same amount of money in a savings account as they had a year ago. They may even have more. Yet if the cost of housing, food, transportation, insurance, and health care rises faster than the growth of their savings, they are effectively becoming poorer despite seeing larger balances. Purchasing power is what truly matters. Money is only valuable because of what it can buy. When purchasing power declines, the effects spread throughout society. Retirees living on fixed incomes feel pressure. Workers demand higher wages. Businesses face increasing costs. Families find that expenses consume a larger share of their income. The challenge becomes especially difficult when people focus on nominal numbers rather than real purchasing power. History provides many examples of this phenomenon. Different countries have experienced varying degrees of currency weakness, inflation, and purchasing power erosion. While each case is unique, the lesson remains consistent. The value of money is not determined by the number printed on a statement. It is determined by what that money can purchase in the real world. As purchasing power changes, financial markets often produce signals that appear contradictory. Stock markets may continue rising. Real estate values may increase. Investment portfolios may reach record highs. These developments create a sense of confidence and reassurance. Many investors conclude that everything is fine because asset prices are moving upward. Yet rising asset prices do not automatically mean increasing wealth. Sometimes asset prices rise because the measuring unit itself is changing. Imagine using a ruler that gradually shrinks over time. Objects measured with that ruler would appear larger even if their actual size remained unchanged. Financial markets can behave similarly when currency values weaken. This is why sophisticated investors often focus on real returns rather than nominal returns. A portfolio that gains 10% while purchasing power declines by 8% has produced a very different outcome than the headline number suggests. Understanding this distinction becomes increasingly important during periods of monetary uncertainty. Real estate offers another example of how financial conditions can create complex outcomes. Many families view homeownership as the cornerstone of long-term financial security. For decades, this assumption often proved correct. However, housing markets depend heavily on borrowing costs. Most homebuyers do not purchase homes entirely with cash. They rely on mortgages. The affordability of a home, therefore, depends not only on the purchase price but also on interest rates. When mortgage rates rise significantly, monthly payments increase even if home prices remain unchanged. This creates an important dynamic. A house may retain a high market value, yet fewer buyers may be able to afford it. Sellers who expect to receive certain prices may discover that financing conditions have dramatically reduced the pool of qualified buyers. This does not necessarily lead to immediate declines, but it can place pressure on housing markets over time. For individuals planning retirement, this issue can be especially important. Many retirement strategies assume that home equity will serve as a major source of future financial security. Those plans often depend on market conditions, financing availability, and beer demand remaining favorable. When those assumptions change, long-term projections may need adjustment. While financial assets and real estate face these challenges, another category of assets often attracts increasing attention during periods of uncertainty: tangible assets. Throughout history, investors have frequently turned toward assets that possess intrinsic usefulness or scarcity. Precious metals, productive farmland, energy resources, and certain commodities have often played this role. The appeal of tangible assets is relatively simple. Their value does not depend entirely on promises. A bond is a promise. A currency is ultimately supported by confidence and policy. A tangible asset exists independently of those systems. It may rise or fall in value, but it retains physical characteristics that cannot be created through accounting entries or monetary policy decisions. This does not mean tangible assets always outperform financial assets. Markets move through cycles, and every asset class experiences periods of strength and weakness. However, history suggests that tangible assets often become more attractive when confidence in monetary systems begins to decline. One reason central banks receive significant attention is because they manage national reserves. Their decisions often reflect long-term, strategic thinking rather than short-term market speculation. In recent years, many central banks have increased allocations to certain reserve assets, particularly gold. These decisions are closely watched because they may provide insight into how policymakers view future monetary risks. Understanding these trends does not require predicting economic collapse. In fact, extreme predictions are often less useful than careful analysis. Financial history teaches that transitions usually occur gradually. Economies adapt, markets adjust, policies evolve. The future rarely unfolds exactly as either optimists or pessimists expect. The real value of studying these patterns lies in preparation rather than prediction. Investors who understand historical cycles are often better positioned to respond thoughtfully rather than emotionally. They recognize that diversification matters. They understand the importance of managing risk. They appreciate the difference between nominal gains and real purchasing power. Perhaps the most important question individuals can ask themselves is surprisingly simple. What do I actually own? Not in terms of account balances, but in terms of underlying exposure. How much of my financial future depends on promises? How much depends on productive businesses? How much depends on real assets? How diversified am I across different economic outcomes? There is no universally correct answer. Every person has unique goals, circumstances, and risk tolerance. Yet asking the question itself can provide valuable clarity. Many people spend years focusing on returns without considering the underlying characteristics of the assets generating those returns. History suggests that periods of economic transition reward those who remain informed, patient, and adaptable. Panic rarely produces good decisions. Fear encourages impulsive actions. At the same time, ignoring structural changes can be equally costly. The challenge is finding a balance between awareness and discipline. The coming years may present opportunities as well as risks. Technological innovation continues advancing. Businesses continue creating value. Economies continue evolving. Human creativity remains one of the most powerful forces in financial history. Yet these positive developments exist alongside significant debt burdens, monetary challenges, and demographic shifts that cannot be ignored. Ultimately, financial success is not determined by predicting every market movement correctly. It is determined by understanding the environment, managing risk responsibly, preserving purchasing power, and maintaining flexibility when conditions change. The individuals who navigate uncertainty most effectively are rarely those who make the boldest predictions. They are often the ones who remain thoughtful, informed, and prepared. The future will almost certainly look different than most people expect. It always does. But understanding the lessons of history provides a valuable advantage. It allows us to recognize patterns, question assumptions, and make decisions based on evidence rather than emotion. Whether the years ahead bring stability, volatility, growth, or adjustment, those principles remain timeless. In the end, wealth is not simply a number displayed on a screen. It is the ability to maintain purchasing power, support the people who depend on you, pursue opportunities, and preserve freedom of choice. And throughout history, the individuals who understood that distinction were often the ones best prepared for whatever came next.